So the main idea of the buyback program is actually quite simple, right? They want to give investors some extra confidence that you can always exit the market in a safe, orderly manner if needed. My name is Ang Lee. I'm an associate professor in finance at the Smeal College of Business. The Treasury came out and announced that they're actually going to double the amount of long-term debts that they're going to buy back compared to what they've been planning, right? So this is not 100% new. Now, I think what is important for us to keep in mind here is that by doing this, they do not pay down any debt on a net basis, right? All they're doing is they buying old long-term bonds, and they have to issue new short-term bonds to pay for it, right? This bond market goes back a long time, and I would say back to the early 1900s, and maybe earlier than that during Civil War. And the idea is very simple, right? So how do you raise financing? You get a piece of paper and you say, if you can keep this piece of paper until a certain date, let's say after the war, okay, I'll pay you $100, whatever they call the face value. Now, and the idea is that you're willing to hold on to that piece of paper is because as long as you hold on to that piece of paper, then you get paid by the end. And so the idea of issuing bonds in the market is very smart because it offers both parties, the lenders and the borrowers, some kind of flexibility, right? Now, let's say that 3 months down the road, you need money, right? You don't need to go back to me, ask for money, right? So, I mean, think about 100 years ago. If you want money back, you have to ride your horse, go to Washington, D.C. and ask for your money back. You don't. You can turn to your neighbor and say, hey, do you want to buy this piece of paper, right? And then by selling that piece of paper, you get your liquidity back, right? Now, on the other hand, from the government's point of view, now issuing bond is also a very smart idea. Now, for example, throughout the year, there'll be times when you have tax receipts coming in, you have bundles of cash, and you want. I think a smart thing to do is to kind of use this extra cash to pay off the debt that you're owing. And how do you do this? Well, it's very easy. You don't have to track down all the people and ask for the pieces of paper back. All you need to do is to go to the bond market and buy back those papers. And that is a very convenient and easy way for you to retire the existing debt. The additional buyback is in terms of billions of dollars. I would say that those amounts are relatively small compared to the overall size of the Treasury market, which is at about between 30 and 40 trillion dollars, right? So I would say that it's very hard to say, to quantify what's the exact impact is going to be. Yeah, so two things. I mean, I think it's important, again, to say that with the buyback programs, we're swapping long-term bonds with short-term bonds, right? So in doing that, the Treasury is not going to pay down any debt on a net basis, right? Number two, I feel like the fact that we're crossing the $40 trillion mark is hardly a surprise to anyone, in particular, those investors in the fixed income markets. They knew all along that it's coming, right? I mean, I would add though that in the fixed income market and in my line of work, we're actually looking at a slightly different number, which is the interest expense. So I would say that the total amount of interest expense that we're currently paying is at historical high, right? So right now we're paying about $1 trillion. So that's about 3.2% of GDP, right? The short answer is that the interest number is what taxpayers have to bear, right? So for the same 40 trillion side number, right? Now, if you're paying 10% interest, right, then the cost to taxpayers is going to be different. Compared to if the interest rate is only 1%, the cost to taxpayer is going to be 10 times smaller, right? So I would say looking at the net expense, how much taxpayers have to bear would be more relevant, right? I did look at a chart in one of my papers recently, and if you charted, right now, we at, like I mentioned earlier, at a historical high. So if you trace it back, I think to the 90s, we actually level at that. But then if you look at the trend, it's going through the sky, right? So. In my line of work, I look a lot at the yield curves. So the fact that if you're borrowing long term, on average, it's more expensive compared to borrowing short term. So I would say that any idea about swapping out the long-term bonds that you pay high interest rates on, and replacing those with short-term, cheaper, relatively financing, I would say that definitely deserve some consideration, in any policy discussion. So after the announcement, the yields dropped by a modest amount, and then after that, today they went back up again. So to exactly quantify the direct impact of the announcements for the average investor, for the average consumer, I would say it's very, very hard to say. My guess is going to be negligible. If you happen to be investors that live off on CDs, I mean, short-term interest rate obviously more relevant, right? But if, like you said, I mean, if you a homeowner, you're paying the 30-year mortgage, which is very tightly linked to the 10-year Treasury yield, then clearly that's a different consideration altogether, right? Yeah, I think along a very similar line. So basically, the idea is instead of issuing like bond, but then you pay like the short-term interest rate. So think about that. The same idea is like as a homeowner, you get it. Basically, the trick here is, as a homeowner, you can't afford to keep going back to the market.